I think people are coming to the conclusion that the president doesn't have a lot of incentive to deal, which is to say the economic numbers are quite good. There's a sense perhaps the economy's peaking too early from a political point of view, so there's an incentive to wait. There's more bipartisanship on trade, I think, than people had thought. I mean, last week you had Steve Bannon and Tom Friedman basically singing from the same hymnal on this. And then the markets themselves are down. It's bad, but you know, the S&P is up 12% year to date. So it's not good to see it go this way, but you still have some room to play with. So I think people are coming to the conclusion that the president's not going to fold anytime soon. It doesn't look like China's going to fold on any sort of structural reforms either.
Which became clear throughout the negotiating process. You have an interesting line that China believed incorrectly that Tim Cook was the same thing as our chief trade negotiator, and that was a big miscalculation.
Well, I think that's, you know, that was largely, since China joined the WTO, you have to say large companies largely ran the table in terms of our trading relationship with China. And I think Donald Trump, whatever you think of him, is representing a different constituency. He's not a corporatist, he's a populist. So it's a subtle change, but it's a meaningful change, and I think China's starting to figure that out.
Joe, this morning, some interesting data that the market did not like. The market numbers, the early read on manufacturing and services fell to nearly contraction territory for the U.S., and the rhetoric was interesting. They said the trade war is weighing on confidence, that things could get worse because new business orders are collapsing. We're not seeing it in the real economy just yet. The jobless claims figure was very good. Home sales are basically fine, Joe. Are we overly concerned about how much this will really hit the economy, or is it just too soon to tell?
Both. I think we're overly concerned, but we can't prove it because it is too soon to tell, Kelly. I mean, the Q1 GDP numbers, as I've highlighted before, really weren't that robust. You had government spending and inventories, and a large inventory correction is likely this quarter, and that's why the market and most of the manufacturing data are going to be soft. So that doesn't surprise me. And while China certainly, you know, this is going to hurt, you know, sentiment and risk-taking, I come back to the point that the Fed has raised rates a lot in this business cycle, more than any other central bank. To me, it's too much. Growth is slowing against the backdrop of very weak inflation. And that, to me, is still the bigger concern in my mind, because we've seen weakness in housing and autos. And that's why the Fed has to take back some of this tightening. And that's why I continue to look, as I have early on, for rate cuts.